Hi, welcome to Let's Talk Bonds, the budget special podcast from INR Bonds. I'm Arjun Patsati. And with yesterday's budget, the union budget for 2022-23, which was presented to the parliament by the finance minister, where the government unveiled a very, very large borrowing program, uh, basically to fund a lot of their capital expenditure and many other expenditures. The result was a very sharp rise in interest rates. So just to give you a perspective, the benchmark for interest rate is the government bond yields and GSECs or government bonds. And GSEC yields rose very sharply yesterday. Before the budget, the 10-year GSEC, the 10-year benchmark bond, was trading at levels of 6.65%. And after the budget, as of today, it's gone up over to 6.9%. And similarly, all other bonds have also gone up. 5-year bond yields have gone up to 6.2%. The 15-year bond yields has gone up to 14 to 15-year bond yields has gone up to 7.35%. And the very long term 2050-60 bond yields have gone up to over 7.4%. And clearly, all these yields were much lower, quoting much lower uh, just a few weeks back. And even in over a 1 year period of time, all these bond yields have risen by over 1% or 100 basis points. Now, clearly, I think we are in a rising interest rate scenario, and this rising interest rate scenario could potentially go down over a couple of years as well. Now, the reason is that on a global front, inflation is very high in the developed economies. US inflation is at 7%, and which is multi-decade highs. Eurozone inflation too is at record highs, and all other countries are experiencing very high inflation. So the response to this very high inflation is that before it becomes structural in nature, all the central banks, starting with the US Federal Reserve, they are all starting to reverse their ultra low monetary policies, where they brought interest rates down to 0%. So from starting next month, the Federal Reserve or the Fed will start to raise interest rates by and will carry on for this year and next year as well as. And if inflation continues to stay high, they might have to take other measures too. And this is going to hurt markets all over the world. And India too is experiencing high inflation. In this budget, the finance minister couldn't uh, bring down taxes clearly because the need for revenues is there. They didn't raise taxes, which is positive, but with fuel prices rising globally and a lot of goods and services, prices of goods and services rising very sharply in the last 2 years, largely because of the excess money that is being printed by central banks, including the RBI, is leading to very high inflation expectations. Now, in India, the interest rates are very low. RBI has brought down interest rates to 4% levels, and all investors will know that at the for the savings in fixed income, fixed deposits are earning nothing. So are mutual funds and etc. So they are searching, and till now at least their interest rates were not rising, so they were protected from higher from fall in prices, especially if they had invested in mutual fund units and other mark-to-market products. But now with interest rates rising, all their investments too are at risk of capital loss. So this is going to pose a very big dilemma to investors and financial advisors, mostly to financial advisors who advise investors on where to invest their money. And in the fixed income side, there is everyone scratching their heads on where to invest because nothing seems to be looking good. So, in this case, so where do you invest? How does one play this strategy out? So, first is to accept the fact that you have to that interest rates will rise. So when you accept the fact that interest rates will rise, then how do you plan your investments? So when interest rates will rise, the first thing to clearly stay out is something that will erode in prices much faster. So when interest rates rise, so that means you have to avoid anything that is having a longer maturity period. And the second is that given that interest rates are going to rise, what to do, the main um, investment strategy should be that to take advantage of higher interest rates as you go forward. But for that, you need to invest in investments that mature earlier without giving and also those investments should at least earn a reasonable return. So parking it in fixed deposits and waiting for interest rates to rise over the next 1 to 2 years will still earn very minimal returns because fixed deposits are earning nothing, even liquid funds. And but if you park it in, say, something which is susceptible to price movements, then if even if it's short-term money, if you have to withdraw and invest somewhere else, then you face a lower returns or even capital loss, depends on which where you're investing in. So clearly what you need to find, especially is bonds that are providing a reasonably good return, um, and also maturing in a shorter period of time. So you can either invest just in short maturity bonds, or if you have to invest for a say 2 year period or a 3 year period, just invest in a say one or two or maximum 3 year kind of maturity ladder bonds. You can ladder it if if the portfolio looks right, or you can just invest in uh, diversify your portfolio, but within a very short maturity band with reasonably good yields. Now, there are cases for floating rate funds where floating rate funds are funds that invest in bonds where the bond yields are linked to a benchmark, and with the benchmark yields moving up, the bonds also will give you higher interest rates. So floating rate funds are one option, but you need to see because there are clearly a lack of bonds where uh, there are not too many bonds where which are floating rate issued in the India. The government issues floating rate bonds, but they are also but they offer very low yields, closer to 4.5% types. So that's not going to really help any investor. And even if it goes to 5.5% over the next 1 year, that's also not a very great uh, yield for one to look at. Many funds, what they do is they invest in bonds, fixed bonds, and they use derivatives to make it floating rate. The derivatives in certain points of time can give mark-to-market profits, but if the idea is to keep it as a floating rate fund, then you will have to carry the derivative to maturity. And with many of these derivatives, especially over-the-counter derivatives, uh, benchmark to overnight money market rates, then there is a negative uh, return on these just by holding the swaps and derivatives, and so that can eat into returns of the funds. So unless a fund manager manages that hedges dynamically, then clearly there could be a loss of uh, returns as well in floating rate funds. So depending on which fund is smarter than the other one, you need to check which fund is the right one to invest in terms of floating rate. If you have to look at very safe options, then the other safest options would be to invest in um, small saving schemes like post office, where maturity they can give you up to 1 2 years of kind of um, fixed deposits, etc., savings deposits, or but that's not that quantum can't be too high. Or you look at clearly looking at again getting back to bonds that can give you very reasonable returns. And now many investors, like we had mentioned earlier, are moving more and more towards market-linked debentures or MLDs, and these are providing both capital tax relief, as well as depending on the investors, the way they look at the tax. We are not commenting on the tax here. And also the fact that some of the all these many of these MLDs can also give higher returns to the investors. So these are the basic options that investors and financial advisors need to look at. Clearly, there are so clearly the once the um, strategy is that it is where the investments is to be made in rising interest rate scenario, which is going to stay high. Interest rates are going to rise over, say, next definitely over the next 1 year, and maybe going closer to 2 years or even higher. Then how do you? I mean, then that's when the strategies all come in. So these clearly every environment provides opportunities, and so hence, if you can find the right bonds which are and which can provide reasonable returns, as well as mature in short period of time, and the funds come back to you, then interest rates are higher at that point of time, then you get better returns when you reinvest those proceeds. So that's where it is in terms of how to invest in a rising interest rate scenario. Don't forget to download our Quick Invest app, where you can find the bonds that you require to invest in a rising interest rate scenario. The app is available on for Android and iOS users. And all you need to do is download the app and then look at the bonds that are available for investments and click on the buy now button or invest now. And that takes you straight to the investment transaction. Thank you very much for listening in. And you do not forget to subscribe to our YouTube channel, as well as press the like button on the YouTube. Thank you very much.